Ladies and gentlemen, it's your boy, Ryan Dins, and on today's episode, we're going to discuss one of my favorite REITs, probably my favorite REIT, which would be Realty Income, with the ticker symbol O, also known, sometimes people call it O Realty, just because it's easier to say. Now, it's a commercial REIT, and it basically buys commercial properties that all of us have known and grown to love. A couple examples. If you go on their website, I found it kind of funny, is one of the pictures in their actual company website was of a Taco Bell. Just to give you an idea of what kind of buildings they own. They own movie theaters, restaurants, gyms, all sorts of commercial, retail type of businesses. Now, first I want to say the good news. COVID didn't really hurt them that much. A very important part of O Realty's business is that the rents come on time. And what happened during COVID is a few people couldn't pay. Some of the gyms couldn't pay, and unfortunately 75% of the movie theaters were unable to pay rent. Wow, shocking. Turns out that if you don't allow people in a movie theaters can't make money. Wow, who would have thought? But with that being said, 93% of their tenants have been paying rent in the month of March. You know, it's not 100%, but 93% is still pretty good. And they're still growing. You know, they're in the mid-60s now. It's a little bit higher than I like to be, but anything below 60, this is clearly a buy. They have a PE ratio of 56. When you look at REITs, you don't judge the PE ratios the same way. Now, normally when I look at a stock, if it has a PE ratio of over 30, I don't even touch it, except Microsoft and Apple, because they're high growth stocks. But with REITs, you're looking towards the future. They're going to continue to take their profits and put them into buying more real estate and continuing to grow. Yes, their PE ratio is 56 times earnings. However, if they keep putting all their profits into it, it's going to continue to grow. And it's got a pretty good dividend. It's almost at 5% right now. When I first started buying it, it was at 5%. Right now, it's in the high 4s. But you know, you want to put $1 million into real estate, it'd be a lot of work. But if you put $1 million into this, you know, you make your $50,000 a year with hardly any effort. That's why a lot of investors, they don't want to get their hands dirty with the real estate. It's easier to just buy these REITs, and I could see where they're coming from. I mean, I've done both. I flipped a duplex. You know, it was a rental property before I sold it, so it was good profit there. This is easier. You just put it in a REIT, and basically you are investing in all of the properties of that corporation. That's kind of how a REIT works. You could buy hundreds of movie theaters, hundreds of restaurants, or you could just buy a tiny stake in a company that did that for you. I'm going to continue to buy. If I see it peek its head below 60 again, I'm definitely going to buy some more. I regret not buying more when I had the chance, because now it's a little bit high in these mid-60s. I still think it's going to go to 75 or 80 within the next 3 years. So there is growth, and it's got a really great dividend. One of the best dividends of any stocks I own. Even though it's a REIT and it's not a stock, it does operate as a stock. And one thing you gotta love about REITs is those monthly payments. It's not that much of a difference to get 12 payments a year instead of 4 payments a year, but it does compound quicker, and it does make you feel good to get that each month. You know, the amount of shares that I own in O right now, it's not that much. It's a little bit over $1,000 worth. I get about $5 a month. I mean, that's pretty good. It's not a ton of money, but it's good to see that every month. This is one of my favorite stocks. I just want to be completely transparent. This is one of my top 4 positions. But yeah, it's one of my 4 biggest positions, and I'm going to continue to buy some more. The only reason I haven't been buying a ton, like I said, it's a little bit high, and I already own a lot of it. I don't like to own 10% or more of a particular stock, and right now it's about 11% of my holdings. So I'm going to ease off until my other positions can catch up, and it's less than 10%. Or if it dips below 60, I'll ignore that and just buy more, because then it'll be a sick deal. You know, 55 would be a steal. So if I see it go to 55, I'm going to be loading up, ladies and gentlemen. So that is the episode. Make sure you hit the like and subscribe button. I will be posting videos like this every single week. The channel's growing, so also hit up my group. If you look in the comments, you're going to see a free Facebook group called Dividend Stock Mastery. We have a lot of killer members, always sharing their portfolios, always sharing their moves, so you're going to want to join that too. All right, thanks for joining. We'll see you next week.